I stand on top of shit. We doing this shit. I went to pay like I can tell. I just got me a beam. Used to ride his theme with some hottest jalapeno.
Yo, Going Parabolic. We're back. We got, we're doing ThorChain today. Big hack. These guys will be on in a minute. It's gonna be cool. It's gonna be cool. Just hang out for a second. Looking forward to the discussion tonight. The you know, as you guys know, I've been really interested in RUNE. I've been staking RUNE on RUNE Vault. Again, it's just a test. I'm really interested in these tokens that you can stake, Tezos, Decred, etc. It's led me to look into DeFi and some of the mechanisms there. Recently, I made a six-figure purchase of some Chainlink. Doing a lot of work trying to understand oracles, which I think you know, is very interesting when you think about deterministic modalities. That's pretty cool stuff. All right, I think the guys are here. Hello. You guys audio working? No, not yet. They're having some audio problems, it looks like. There you are.
Hey. Can you hear me?
Hey, can you hear me?
Good. I can hear you fine. Can you hear me?
Perfect. Yeah, gotcha. Good to meet you.
Yeah, likewise. Do you mind just giving me permission to share my screen?
Yeah, of course. Here, hold on. Let's see.
I think you might need to.
Let's see. Why don't I have permission? Let me, oh.
I'm sharing.
Yeah, it's up. Yeah, it's cool. Awesome.
Cool, awesome.
Listen, thanks for doing this, first of all. And as you know, I'm one of the GPs at Morgan Creek Digital. Beyond that, I'm super interested in this project. So this is kind of a due diligence. Teach me everything you can.
Yeah, indeed. Kai is the project lead. He'll be joining shortly. And my role with the project is just one of the researchers. So I can speak technically to how the protocol works. And I guess Kai will talk about the project, team, vision, roadmap, that kind of stuff. So he'll be here soon. But yeah, so the team tell me that, yeah, you've been supporting the project for about almost 6 months now.
Yeah, definitely. I was put on, I think I read a paper that was done by the Delphi digital guys. And I was really impressed with, I'm always impressed with the work they do. First of all, I'm not an investor. I'm a big supporter of theirs. And, you know, after reading the paper, I was like, man, this is really interesting. So anyway, you know, I made a purchase of RUNE, and I've been staking it, or whatever you call it, in RUNE Vault.
Okay. Yep. Nice.
So, you know, and beyond that, just trying to follow what you guys are up to.
Yeah. Oh, that's good. Yeah. So the Delphi guys, they basically started looking at the project in this December, January. Andrew Kang kind of made that connection there. And yeah, they did, obviously know they did a report, and then next thing you know, the Delphi digital report was being circulated. So that's good. So Como a bit delayed, so we'll just get cracking.
Sure.
I guess I've got some screens prepared.
Kai is here.
So, Kai is here.
Yeah, I just let him in.
Okay, awesome. Hey, Kai.
Good morning, good evening. Hey, JP,
Kai.
Jason, how are you?
Very well, thank you.
Awesome. So we just jumped on Kai. So we just did a small intro. Jason's recording a podcast. He's been following the project for 6 months, likes the direction so far. And one of the researchers, can talk technically. Kai's the project lead, can talk about the project, the roadmap, and whatnot. So I guess if you've got a particular format, Jason, else we were just going to speak to 20 minutes worth of tabs, and then you could field questions on the way or whatever.
Sounds great. Yeah, just like I said, I want to learn as much as I can. So you guys
Awesome.
just.
Excellent. JP is probably going to be doing most of the talking today because we're in COVID lockdown here, and I've got a bunch of kids in the background. But I'll jump in as and when needed.
No problem.
And Jason, when did you want to say kick off the recording of this? Did you want to do like a small intro, or
No,
are you just
go.
letting the mic run?
Yeah, just go.
Cool. All right. So ThorChain is a decentralized liquidity network, and a simple way to explain it, it's a cross-chain UniSwap. UniSwap's been out in the wild for 18 months. In fact, some members of the team were there in Croatia and DevCon 4 when it was announced. And we're actually day zero liquidity providers on UniSwap. They had been researching the concept of incentivized liquidity pools for the previous 6 months. So we're very familiar with what UniSwap were doing 18 months ago and knew that it was onto a hit. ThorChain itself came out of a Binance
May I interrupt you as you go?
Sure. Yeah, go for it.
So just if you can help me with this, my experience with UniSwap, if you try to do anything of any size, there's huge slippage and it's ridiculous. You could, if you're not careful, you could spend 9% in transaction fees on UniSwap.
Yeah. So those transactions,
that is ridiculous.
Yeah. So there's two components to that. There's actually the fee that you're paying, which is 30 basis points, and then the slip. Now the slip is a function of the depth of the pool. So roughly an idea is if you are transacting in a market that has 12 million of liquidity and you do a 120 grand transaction, so 10% of its depth, then you'll experience roughly a 10% slip. So this price, this you see here, one ample is 0.07. You will move that 10% because you're demanding 10% of the pool's liquidity at any moment.
Why would anyone participate in a transaction like that? Sure.
So the idea is that liquidity is on demand and there. It's not fake liquidity, as in this is real liquidity that you can access at any given time. And there are people providing that liquidity. So they come and they stake the liquidity in these pools for fees. And they will, if the fees are good and the revenue is good, they will in turn be incentivized to increase the depth. So your pools can become deeper over time. Now, there's the concept of market makers and market takers. When you're doing a swap, you are a market taker. You're taking liquidity from the market, or you're demanding of its liquidity. A market maker is passive. They will give liquidity onto the market. So I guess what's missing so far is bringing, liquidity pools solve the problem of bringing market makers and takers together, where the incentives are clear. Market makers are paid to provide the liquidity, and market takers have to pay fees. Now, what you're talking about there is the slip that's generated. Now, a trick that I guess a platform called Curve use is, and Curve is a pretty neat program platform. So let me just pull up, Curve.finance. I'll just skip past that. So these liquidity pools, they're really good at pegging stablecoins together, but the slip here is a lot less, and the fees are smaller. I think there are 5 basis points. I could be wrong there, but the fees are a lot smaller the slip is a lot smaller because they basically use a small trick to amplify liquidity and create virtual liquidity to ensure that you can do large transactions without slipping. Now, the inverse of that is the prices are slower to move away from the point. And it works for stablecoins, but the idea is that we want to solve the liquidity, the incentivization of liquidity. So this depth just keeps getting bigger and bigger. So you can come and do $1 million transaction and not cause measurable slip. So that's the idea behind ThorChain, is to maximize incentives for liquidity in a way that makes pools nice and deep for users to swap.
So wait a minute, that's really important, and that ThorChain is actually solving for the problem I recognized in UniSwap.
Yes, ThorChain aggressively targets fee generation for its liquidity providers, because as you've recognized, the key problem is making this as deep as possible. If this is deep, then everyone's happy because you can come and demand of its liquidity and not pay a small slip. Now, they're actually interesting, Jason, you can either do a large transaction, or you can do small transactions and just be a little bit patient and wait over time. So instead of doing 100 grand transactions, you can cut it up over the course of the day and do small
It's not efficient.
10 grand transactions.
Yeah, I'm sorry, John Paul. It's just these microtransactions and small ball plays. They're not scalable. They're not institutional. They're not interesting to me. Like I'm not interested in trying to break $100,000 or maybe $1 million transaction. I'm not interested in sitting there all day and breaking it up. So I appreciate that, but it's just not. I don't know. It doesn't feel right, but you're just telling me we're early.
Yeah. So the key problem is to make this as deep as possible, or the other one which we've discussed, and I'll show the math behind it, but is to add virtual depth. So this is the documents for ThorChain where it describes how to derive the constant product formula and mathematically what that means. But I just want to scroll down to the bottom. I am skipping a bit here, but you can actually create virtual depths. So you basically have a weight applied to the balances. And as an example, if you make both the weights, say 2, then the pool is behaving as though the depth is twice as deep. Now, imagine if you made this 10, then a $12 million pool will act as though it's $120 million deep. So in that case, you could come and do a very large transaction and have really low slip. Yeah, absolutely. So liquidity pools.
Isn't that just simple rehypothecation, or what they do in banks, where a bank may have $1 million of deposits and they're able to rehypothecate that 12x, lend it out 12 times? They don't really have the 12 million. They only have $1 million.
It's not like that. These are bonded token curves. So just stepping back here, because we are skipping quite a bit, but you can imagine a pool having X and Y, so 2 assets, and you want to put in little x, so the input amount, and you want to receive some amount out, so the little y here. Now, the balances service that transaction. And in the case of, say, this pool here, the depth is $12 million. So if you were to put in a little x of 120 grand, you will cause an overall slip, and that slip equation is this equation 4 here, of roughly 10%. So if you were to virtualize those balances and increase them by 10 times, you're not actually rehypothecating anything. You're just smoothing the curve out. So at around the spot price, it's really flat, so you don't cause much slip. But if you push it extreme, then you push that slip towards the edges, so you get better price around the spot, but worse price for large transactions. So yeah, these are liquidity pools, and these are quite these are good questions in terms of discussing the benefits of the CLP model. But Jason, the key problem is the one of bringing together market participants. So making sure that there are people providing liquidity on these liquidity pools, and in order for people to take it. Now, if you were to go to, the current market of where we have the exchanges of Kraken, Binance, etc., and I'm just going to pull up the exchange list. So leading the charge, here we go, exchanges. Then these exchanges are all acting as one giant liquidity pool. And when you do a large Bitcoin transaction on Binance in and out of USDT, you are actually causing slip on their books. Now, if you do it fast enough, you will get the same experience as what you found in UniSwap. But arbitrage will occur. So yeah, you do a giant transaction on Binance, and that ripples out across the other exchanges, and arbitrage bots will rebalance all the pools as you were to ensure that the price is corrected. Now, I think what you found nothing compared to the billions of dollars of liquidity worth on these exchanges. So we are early, and it's a matter of user experience, it's a matter of user education, and it's a matter of incentives. Yeah.
Yeah, well described. So I just to add a couple little color. So on these centralized exchanges, you're obviously going to have, market makers, whereas on Uniswap and ThorChain products like that, you're talking automated market makers. On centralized exchanges, going back to the value proposition of a product like this, you've got layering, spoofing. You don't have all the liquidity that you think you do. You have a lot of wash trading. You can't trust it. ThorChain and products like ThorChain are completely open and auditable, and verifiable. So you can trust that the liquidity on the network is there and accessible at all times. So back to that value proposition of always on incentivized liquidity, ThorChain will enable users to swap from one asset like Bitcoin on one chain to another asset on another chain like Ethereum or any ERC20 shitcoin that you want to swap to in a completely permissionless and trustless setting. So what does that mean? No signups, no asking for permission, no risk of having your coins confiscated to do KYC, right? You don't have to trust anybody. No one's holding your assets in custody. That's huge for users. It's a real paradigm shift in liquidity. So where does that liquidity come from? Just to kind of confirm again, stakers who are seeking yield. They've got unproductive assets. They're not earning anything. They're just hoping their Bitcoin goes up. So they're going to stake them in pools to earn fees on swaps. Yep. And what the CLP model does, which is slightly different to the Uniswap model, and this directly addresses your kind of question, because I'm like you, Jason. Like, I don't have time to muck around. I'm impatient. I like that coin and I want some. Now, you're always going to have that problem when you're early and you're looking to accumulate. And the asset is kind of illiquid. But the CLP model, it rewards stakers more than some of the other models, like the plain XYK that you'll find on Uniswap, because it's a slip-based fee. And as JP mentioned, it's a function of the order size, the trade size, and the liquidity that you're accessing. And what happens is the fees, the stakers who provide that liquidity, the LPs, they get more share, they get more fees, and that has a causal loop of drawing in more liquidity providers. And where there's more liquidity, because we know liquidity begets liquidity, there are more swappers, more volume going through, okay, more opportunity for fees, even though that fee gets slightly lower. So it's this causal effect of liquidity begetting liquidity over time. And that's what the team believe that ThorChain's value proposition, it will bring in always on incentivized liquidity at that permissionless and trusted setting.
No, that's super helpful. So if I take this to a centralized exchange that's providing interest on you in some light custody scenario where you're staking Bitcoin, for example, on BlockFi, for example. If I put Bitcoin on BlockFi, they're going to pay me 3.2% APY to set it there. They're doing the same thing, right? They're providing liquidity.
That's correct. They take your Bitcoin and they lend it out to short sellers.
This is an important question that I don't think many people understand. They don't understand how BlockFi can afford to pay you 3.2% in Bitcoin or 8.6% in GUSD. They don't understand it.
Sure, it comes from the lending, the derivatives market. So if you lend out Bitcoin or ETH, you're giving your Bitcoin to someone who's borrowing it off you, and they are immediately shorting the market. So any Bitcoin bull lending out the Bitcoin is actually providing it to short sellers. If you provide your USD, then you are selling it to, or you're lending it to people who are shorting USD against Bitcoin, or in other words, going long Bitcoin. So that's why there is a market there, because when you short sell or you go long an asset, you actually need to borrow it first, conduct the transaction, and then later on you buy the asset back and then repay your debt. So that's where the interest is coming from. This is a different market. So this is a lending market for derivatives, whereas ThorChain and things like Curve and Uniswap, these protocols pay you for your assets, and they are providing the liquidity, and market takers are paying you that yield instead of borrowers and lenders. Does that make sense?
It does. And you have contemplated, and I'm sorry if I'm jumping around, that once you go through, what is it, BEPSwap?
Yep. BEPSwap's the current single chain implementation. So ThorChain is a blockchain agnostic protocol. It's a network, right? It's a blockchain in and of itself. Yes. And it simply observes external chains and syncs state across those chains. and it manages assets in vault. So it's a leaderless vault manager. And JP is sort of showing you a chart, and he'll probably talk to that. It is actually incredibly simple, but also very complex. JP, do you want to talk to it?
Yeah, sure. So all ThorChain does, and you mentioned that BEP swap, this is the current testnet. You can swap and stake assets right now. In fact, we might even do a demo in a second. But all it's doing is it's observing transactions on an external network. Ethereum, Binance Chain, Bitcoin, it doesn't matter. First of all, as a user, you do that transaction. If you're on Ethereum, you're going to be pulling up your MetaMask. If you're on Bitcoin, you're going to be pulling up your ledger on a desktop client. You do that transaction. As soon as it's confirmed on chain, 10 minutes for Bitcoin, 15 seconds for Ethereum, 500 milliseconds for Binance Chain, the nodes observe that transaction. Not just one, but they all do. And they all separately make a witness transaction to ThorChain saying, hello, I saw this transaction. And in fact, that structure looks like this. So we can see that they are saying, hey, this transaction ID on this chain from this person to this vault had this many coins, 1 Bitcoin. This is the gas they paid, and we can talk about why that's important. And this is the transaction intent. So this is where they're saying, can I please swap to Ethereum? Now, ThorChain will read that, and it will pass it into its state machine. And you can see here, it comes from these clients. They all do these witness transactions into ThorChain. Now, once ThorChain has grabbed all of those witness transactions, so if there's 30 nodes, there'll be 30 of them, 99 nodes, there'll be 99. Once it's got 2/3, it finalizes the transaction and goes to itself, okay, we need to process this transaction. And it's a swap from Ethereum to Bitcoin. Then it goes into what we call the swap queue. Now, this deliberately orders swaps in order of importance. And the important ones, let me tell you, are swaps that pay high fees or swaps that generate high slip. And it's the aggregate of those two. High fees means the system is generating revenue, and high slip means the pool is under active price discovery. So those two are very important qualities. Eventually it will process all transactions. So if you do like a $1 swap for Bitcoin, it will eventually get through, but it's not important at that point in time, and it'll get prioritized last. The most important one is your 100 grand transaction swapping to Bitcoin, and that will be done immediately. Now, what happens is that the state machine generates the instruction, hey, it's a swap, hey, it's a stake, hey, this one needs to be refunded. Actually, no, this one needs do whatever. And then it delegates to a vault, and we'll talk about what vaults are, but they're basically virtual wallets that the nodes control using a threshold signature scheme. And then it simply generates a TX out. Once again, and you might have noticed with the TX in, we call this a TX in, it's chain agnostic. It simply describes the chain literally by a word, Bitcoin, Binance Chain, Ethereum. It doesn't matter where it came from. And likewise, the TX out is also chain agnostic. It simply says, hello, to this node, can you please send this person this amount of coins, and this is the maximum gas you're allowed to spend, and go away and do it. 5 seconds later, you can see here this finalized transaction out will get passed to the signing routine, who will enter a TSS routine, which is a threshold signature scheme, and then sign it and broadcast it to the respective chain. So that's how your transaction is processed. And I might actually do a small demo so we can quickly see how that works. So
that's like what the team refer to as observation consensus. So, Jason, it's quite simple. The network, the network is a bunch of nodes, and they just observe events on external chains, and they use threshold signature cryptography to distributively sign transactions to process swaps across those liquidity pools. The system is always safe at all times due to the incentive pendulum. So you're probably asking, well, what stops one of those nodes from like sealing the Bitcoin out of the vaults? Well, those nodes are bonding huge amounts of capital, and they're underwriting staked assets at a 2-to-1 ratio at all times. And the value of the RUNE's market cap or the network is always 3 times the amount of non-RUNE staked assets. So that's the incentives. And as liquidity pools grow or shrink, the amount that nodes will need to bond to secure the network, to underwrite staked capital, will change at all times. And the incentives or the rewards that are paid out to liquidity providers versus node operators will always adjust to make sure that the system is safe at all times. So sure, if you were to RUNE's market cap at the moment, I don't really check, it's about 80 million or 60 million or something like that. So 2/3 of that market cap would need to be accumulated to be able to attack the network and run away with the assets. So it's really not, the node operators
Yeah,
are really not incentive. Yeah, you're not. It's not
what Kai's trying
profitable.
to say is, yeah, there's an incentive pension we can talk about in a second when we finish the demo that ensures that there is twice as much RUNE bonded as capital as there is staked. And this ensures that nodes are never incentivized to steal any assets, whether it's Bitcoin, ETH, or whatever. And we'll talk about it in a second, but I just want to finish this demo while I've got it on my screen. So we're putting in 10 RUNE here, and we want BNB. And this is actually going via the RUNE BNB pool. And right now, the testnet has 6 nodes. So there are these 6 nodes that are running the system, and they are involved in a TSS routine right now. This is on one of the testnets. So when we go to swap 10 RUNE, the RUNE will go in, the chain will see that transaction, do the swap change, and then send it out. And we'll see how quick it is. And I'll explain how long it takes and why it takes that speed, but just putting my password. So right now I'm broadcasting a transaction to Binance Chain. So we'll first of all see this transaction and see what it looks like. So just pulling up the Explorer. So you see, I'm coming from wallet, and I'm simply telling ThorChain, can I please swap to BNB.BNB because we're in the cross-chain environment, so we need to notate it properly. And I also put in value protection. So I'm saying I want at least 0.28 Bitcoin, 0.28 BNB. And ThorChain is basically reading this transaction, and it's doing this little loop that we just described. So it observed it, put it into ThorChain, finalized it realized it's a swap, delegate to a vault, and then it's going out. And if we go back to BepSwap, it's already done. So what happened? There were 3 discrete transactions. My transaction into the vault, all the nodes witnessed it, put it into the ThorChain state machine. ThorChain did its computation and delegated the outgoing transaction. And now I have my 0.3 BNB. And yeah, so that was the demo.
Pretty cool.
Which is pretty cool. Yeah.
And that's not a trusted setup as well, Jason. So anybody can run an interface for ThorChain. ThorChain is the protocol. It's a network. There's no hosting with front end that if it was to get shut down or switched off, the network wouldn't come down. Right. That's the important thing. It's permissionless. It's trustless.
Right. And you said there are 6 nodes. So let's just, for discussion's sake, say it's 6 different individuals running a node. Each one of those individuals, has 1 million RUNE at least? How do they qualify to be a node operator?
That's correct. So these nodes, you can see here, this node here, it has, it's in 1E8. So let's take my 80. So it's about 100,000 RUNE here. It's about 100,000 RUNE. And this node is also bonding about 100,000 RUNE. So this is part of the active competition. Every 3 days, the nodes will basically try to do a competition. And we can actually see here in this network endpoint, we can see the average bond and the standby bond. And what it's trying to do is it's selecting nodes that have the highest average bond. Currently, there's no node scheduled to be turned in, which is why it's 0. It's selecting the nodes with the highest average bond to go in. So over time, nodes will compete because they want to be part of the system to earn the rewards, which are quite lucrative. And the bonding rate will go up in time. Now, this is where the incentive pendulum kicks off. The incentive pendulum, as discussed in this documentation, tries to keep 2/3 of the RUNE bonded and half of it pooled, connected to these assets. If there's any balance of that, it simply does a small equation, which, believe it or not, is just this here, in order to work out the balance of the system. And it generates a very simple number. In this case, it's 0.33 if you have 67% bonded and 33% staked. And then it will send the respective amount of rewards to either the stakers or the nodes. And so over time, as the byproduct of this aggressive retargeting, the value of the bonded RUNE will always be double the value of the staked RUNE, assuming profit-seeking actors. So nodes will outbid each other to enter the system and driving up the bonding rate. And as the bonding rate goes up, then so does the security of assets. Yeah.
Where have you seen an example of this type bonding and node mechanism be successful historically?
We haven't seen it yet. This is a novel mechanism that has only been validated by us and validated by the Gauntlet. So Gauntlet did an assessment of this. Anyone can read this under the protocol design, but they specifically looked in if this was a stable system. In fact, we'll quickly pull up the diagram in this. That was the wrong one. That was Kudelski audit. And yeah, sorry, here it is here. it's in audits. There's a couple of audits been done so far. So we'll just pop the Gauntlet Economic Security Review. And Gauntlet's takeaway was that this system is stable over a wide variety of, and I'm just scrolling here to go down to the conclusion, and we can see a whole bunch of graphs that look into its stability. But they found that they stress tested the incentive pendulum under a wide variety of protocol and parameters, and their conclusion, it will lead to a stable and healthy system in a variety of market contexts. And they, use the word, it's quite robust. And there's a couple of analysis here. The blue line is the bonded rune, and ideally it should always be double the orange line. And they found that under some assumptions, it is. They also found that it can tend to be over bonded under some scenarios. So you can see here the blue line is much higher than the orange line, which means the nodes are getting paid not much, but the stakers are getting paid a lot. So this scenario here is really good for stakers. It means most of the revenue will be going to you. So this is an example of some numbers that we're using in order to work out the ROI for the upcoming KSNet and testnet 4. And it's looking to be around 22 to 25% per annum. And this is just in the block rewards. We're not even talking about the fees over and above this. And the final point on that was they did found that the system can become insecure when the amount of staked rune is equal to the amount of bonded rune, and there's some scenarios at which that will occur. So you can see here when orange equals blue, but there is a safety mechanism in the system to prevent it ever going over it. So you can see it hits it, but it never goes over it. It fluctuates around it, but it never goes over it. So the system does work. Yeah, good question.
Can you explain to me how because I haven't conceptualized or seen an opportunity to bond rune. I've only staked rune. So I have thought about a node. Can you explain to me, the mechanism, the difference there?
Sure. So the team have been running RuneVault for the last 12 months, and it's a mechanism that you've interacted with, and it's a distribution mechanism to ensure that the system has the correct group of users. Now, when tokens are first distributed, a key problem is a matter of distribution. How to ensure that the people holding Rune are long-term aligned and the correct group of users for the system. So that's one of the reasons for running this platform the last 12 months. It's enabled over 60 million Rune to be distributed to people who are, as the protocol thinks, worthy of holding that Rune because they are participating in its ecosystem. But that's been the only initiative so far. The team are this will be retired very soon. So this platform will make way for the upcoming BEP swap. BEP swap is where you will be able to take your Rune and make staking transactions. So we'll look at this BNB and Rune pool. So you've got to come here, put in some Rune. So in this case, I'm staking 1,000 Rune and 29 BNB, and we'll actually go ahead and make the stake. PS, staking is a lot faster than swapping because it's just a single transaction into the system. So it should be done inside of, I've run out of assets. Okay, I'll do slightly smaller, maybe 100 Rune. Okay, we'll go again and confirm. And this will happen in a few seconds. So here we go, 3, 2, 1, boom, okay, we're in. So I'm staked into the pool, and now I'm actually one of the liquidity providers in this pool. So there's 13 other people, I'm one of them. And right now, at this point in time on our testnet, you can even get a sign, and there's no rewards running at the moment. So this is just fee revenue, and it's only been running for a day. So you can start to see all the APR that could be generated from this. So as swaps happen over this BNB pool, then I'll make income. Now this is going to happen over the next few months. Now your question about how to bond as a node, that's coming very, very soon. So you will be able to take your 1 million Rune if you have it, and the team have released basically overview of how to set up a node via Kubernetes or manually. But this is where you get to write a whole bunch of, basically you're setting up a Kubernetes cluster on AWS with DigitalOcean or Google Cloud. And you can see here one of the transactions in the deploying. You do a bunch of Linux commands, and then finally you get to the point where you bond sorry, here, joining. So you do some checks, and then you get to the all important send bond. So what actually happens is the system will tell you the vault to send your bond, and you'll make a bonding transaction from your ledger, not from your Thor node, but from your ledger. And the team encourage you to practice on testnet, do small transactions first, and encourage you to do it from a hardware device. So it's air gapped in a way. And then now your node is bonded, and it'll be put in a queue to churn in. And then when your node's ready, it will start earning rewards. Yeah.
We've got, so testnet 4, which is the community testnet that we've just released. And over the next few days, we'll be helping some of the future node operators to bond in and to test the network with the team. But the salient point is that running a node is serious business. So providing liquidity is I guess, akin to being a market maker on a traditional centralized exchange, and operating a node is like being the exchange. So what ThorChain is, it's a network of nodes, and ThorChain splits responsibility of operating an exchange in terms of running infrastructure, operating software or developing software, maintaining software, in managing the custody of assets, and also the subjective and management decisions that come with operating an exchange among those 99 nodes. But apart from just setting up your node and managing the infrastructure, so monitoring it, making sure it's operational and live, and you've got network connectivity and so forth, and obviously rebonding, you don't need to participate at all. It's completely passive. It'll just happen automatically. That's the software that does it for you. But the key point is that you are bonding as a node operator. You are bonding RUNE to ensure that the system is safe at all times and that staked assets are always underwritten. So, if nodes are malicious or if they are disruptive, they can certainly be slashed. So it does come with significant responsibility. You are operating a network that in the future will secure hundreds of millions, potentially billions of assets.
Yeah, so what Carl was saying is essentially every Thor node is running an entire qcoin.com or an entire Kraken. It has all the infrastructure that an exchange would have. It observes user deposits. It maintains user accounting, so it knows how much you've got on its system. It allows you to withdraw. But the difference with Kraken and ThorChain is that Kraken just has one server probably and a couple of redundant ones, whereas ThorChain has 99 nodes working together, and it will only proceed with super majority consensus, which is completely unheard of. I mean, even the most secure exchange, aka the one that's never been hacked, and so not BitMEX. BitMEX has got an interesting. I bring up BitMEX because it's a very large exchange. It's got a lot of assets in a system, and it's got a lot of volume. This is run by 3 guys, and everyone knows the BitMEX multisig because it actually starts with BMEX on the deposit, but it's a multisig. So there's two, they carry Chromebooks around with them all around the world, but every morning at 9 a.m. or sorry, evening, 6 p.m. Hong Kong time, they wake up, they review all the redemption transactions, and they manually sign it themselves via the Chromebooks, but they only need 2 out of 3. Now this is one of the most secure systems. Well, it's a manual, but a highly audited system. ThorChain is promising to do that, but in an autonomous way, not with 2 out of 3 dudes, but with 99 anonymous nodes. So it's complete step change, an evolution in how to manage exchange infrastructure. Now, one of the things is to make sure that nodes don't do bad things. So the system automates penalties. So if nodes go offline, they're slow, they don't do things they need to, then they get, they get jailed. If jailed means they get put on, they basically get told to go to the naughty corner for a number of blocks, so the release height, because they are affecting the system's availability, but they also get slashed. Now, slashes takes away from their bond and their rewards. So when they go to exit the system 30 days later, the slash points take away revenue from them. So with that in mind, nodes are incentivized to be online, have really high uptime, be reliable, but most importantly, just run the software, i.e. just run the system, this autonomous software that the team are building, and it will take care of everything. You don't need to do anything. It will run the entire exchange in an autonomous way.
And the most important part of that is no one's going to come and ask you, oh, you want to withdraw some assets? Well, I need your documentation. You know what I mean? The network just passes it through. It just doesn't care. And nodes have plausible deniability about the transactions that they participate in because of DSS. And so I mean, that's not the intent of ThorChain. It's not meant to sort of bypass any, KYC or regulation. It's just the nature of the network. This was discussed in one of the articles that we read yesterday.
Yeah.
About
Thor node can't take your KYC. Who are you going to send your passport to, right? These are anonymous nodes that don't care. I mean, all you know your node by is its IP address. And the second it does anything wrong, it's going to get banned and removed and fined from the system. Pure economic incentives, right? There's no one to send your KYC information to. Now, the bullish case of ThorChain is a couple things.
Aren't these going to, well, I'm sorry to interrupt you, but aren't these going to be made illegal to operate out of, let's just use the United States, for example. You're not going to be able to use a DEX.
So here's the thing. The ThorChain is a back-end protocol. Anyone can write a web interface or a desktop client that interacts with the system. And you can see it actually runs HTTP and not HTTPS because it doesn't have domain names, right? We don't care about domain names. The system doesn't care about domain names. You simply connect right through on its IP address. You're literally talking to the node directly. There's no need for domain names because there's no certificates required. So anyone can write a client. And by the way, the team have made a module that can automatically proof a node for you. So if you don't trust the node that you're connected to, you run this package, and it will prove to you that the information you're getting from a node is correct. And it does this through consensus, and it basically automates it. By proving
the only way that it can be shut down is if the state actors accumulate the RUNE. So if ThorChain is like a $1 billion network, well, a government's going to have to acquire, $750 million in RUNE to be able to attack the network and steal assets and shut it down.
Well, I'm not necessarily saying they can shut it down. They can just make it illegal for you to use it. That's kind of where I'm going for. These avoidance of AML KYC. They're interesting to me, but they're circumventing an institution that the United States wants to protect. That's all I'm saying.
Right.
Like,
yeah.
Look, there is absolutely no way that once the government catches up to the technology, because they're way behind here, once they catch up, they're going to go, no, you're not going to be able to move money anonymously through decentralized exchanges. And
because
we'll just blacklist those addresses. I mean, that's where it will end up, right? So, it doesn't matter.
Jason, here's an interesting point, and I want to cut through the clarity here. When you send a Bitcoin, you're actually sending Bitcoin. You're swapping one Bitcoin to 1.0 Bitcoin. Because when you send a transaction, you consume the UTXO. So we're talking deep technical Bitcoin stuff here, but you actually use up your UTXO, you destroy it, and you create a new one with just the same amount of Bitcoin. If you try to do more, no one's going to approve your transaction in the Bitcoin ledger. So when you do a Bitcoin transaction, you're actually swapping Bitcoin to Bitcoin, right? But no one's going to stop you because no one can censor your Bitcoin transaction. The ThorChain allows you to swap units of one coin to units of another coin. It just doesn't have to be the same one. In the same manner that when you do a Bitcoin transaction, you're swapping one Bitcoin to one Bitcoin from a different address.
But that's slicker and even more dangerous.
So that's the team. I mean, the team recognized this, and while we will never run nodes, the system is built in a way that you can't shut it down. Because you could blacklist this IP, but there's nothing stopping this node shutting down the system from the ledger and starting up a new one. And they will do that because there is a lot of money to be made from ThorChain's block rewards and fees. So there's a case that entrepreneurs shouldn't bother doing things unless they're illegal already. Like Travis and Uber was illegal, Airbnb was illegal. Yeah. Like all things are illegal till they are just normalized. So we're not saying that, ThorChain today is not either legal or illegal, just in the same way that Binance is legal or illegal. It just allows you to do transactions. And there are definitely exchanges out there that Uniswap as an example, that will allow you to exchange these assets in a permissionless way. And that is the future. And if you try and add gates or borders or preventions and you try and gatekeeper it, then it's just a matter of time before the people want their way and don't want
Well, and
their
it
data out
sounded
there.
it sounded like you were taking me to a place that would allow me to put a front end. If I wanted to use ThorChain, there could be a front end interface that allowed me to do AML KYC. It sounded like you were taking me there.
Right. So there's nothing stopping an exchange
Right.
wrapping this in KYC AML and doing it legitimately.
Right.
100%.
And I'm not
Cool.
even saying like legitimately. I'm just saying that the rules of that particular country mandate it.
Yeah. And anybody can integrate ThorChain into their wallet, and the future incentives of the protocol will include what did you call it, JP? What are we calling it? The protocol referral fee, the referral fee, so that anybody integrating ThorChain can get a cut of every transaction, and that means that ThorChain's liquidity pools are accessible to any wallet. In fact, it'll be such a killer feature if you don't build in integration for ThorChain into your wallet, then you're just going to miss out on users, because who doesn't want to access instant liquidity?
Correct. What Kai was saying is there's a feature we're discussing with current wallets and exchanges right now. But going back to this transaction, what it will look like is the wallet that I sent this transaction from, because I sent this from the BepSwap platform. I signed it using my key store and I sent it out. I could be doing this inside of BitMax or inside of a mobile wallet. Now, what ThorChain could be doing is adding the wallet's income address there and saying, can you please pay this wallet 10 basis points of my RUNE? So now the wallet, which allowed you to connect to ThorChain and sign that transaction, is taking a 10 basis point fee on every swap. If you don't like that 10 basis point fee, don't use the wallet. Go to some other exchange. So this is a protocol level referral scheme or revenue scheme in a trustless manner and a transparent manner for all exchanges and wallets to use, so that they can continue running their business model and doing what they do best, which is maintain a brand, customer service, interact with users, comply with local regulations. But at the same time, they can ditch their siloed liquidity, because this liquidity is siloed from this liquidity. Imagine if these two liquidity pools were connected. That's what ThorChain. So the future of exchanges is all of these exchanges deleting their backends and connecting to ThorChain's backend, because it's a single global liquidity pool that they can interact with. And they don't need to change anything about the user-facing business model.
And has Binance drunk the Kool-Aid with ThorChain? Why are you, or are you working with them in some strategic way?
Yeah, so there's a couple of things happening there. The team are in conversations with Binance on various things, use of the chain, et cetera, et cetera. Their Binance chain is really good because for this stage where the project is, because it's fast, it's easy to read this information. The chain doesn't reorg, the chain doesn't fork itself, it's available. So for these reasons, it's been very easy to build the all-important Bifrost. The Bifrost is the mechanism for connecting through to the chain. Ethereum is a little bit harder. Bitcoin harder still, but these are all solved. And indeed, the team have already written the chain clients for them all. Here's the Binance chain client, Bitcoin and Ethereum. So this is all quite mature code. It just needs to be more adequately tested in an asynchronous environment. But Binance has so far been the easiest for those reasons. So that's why the chain is launching onto Binance. The asset is on Binance for those reasons, yeah. But I just want to highlight, there is no difference to how ThorChain is today to when it's tomorrow and it's multi-chain. The only thing you'll see is Bitcoin pools, BNB pools, and F pools. But in terms of the system, in terms of how the system sees the asset, this could be Bitcoin.Bitcoin, and this could be this Bitcoin. It doesn't matter where that Bitcoin is. Yeah. So there's no change, and this will happen.
Yeah, sorry, I just wanted to reinforce that point, because one of the common, I guess, misconceptions about ThorChain is that ThorChain built on Binance Chain. Well, the RUNE asset is a BEP2 asset on Binance Chain, but ThorChain is its own beast. It's built on Tendermint Cosmos stack, Cosmos SDK. It is blockchain agnostic already from the ground up. It's independent, and at the moment, all that the nodes do is observe RUNE on Binance Chain. right? So native RUNE is coming very soon. So RUNE will be native to the ThorChain network. But the RUNE asset could be on any chain. It could be on any, well, preferably on any chain with instant finality. So yeah, it is already blockchain agnostic, and integration with Bitcoin and Ethereum is happening right now. We can talk about the milestones later on, but the single chain chaos net, so which is currently we're on testnet, so we're in the final stages of kind of testing and bringing in nodes. ChaosNet will launch in a few weeks, which is a dress rehearsal for mainnet, and will feature ThorChain on Binance Chain's mainnet. So real BEP2 assets, real BNB, real RUNE, real FSN, whatever asset you want to see. There will be an initial cap of about 10 grand, and that will increase every day or every couple of days, upwards of 250 grand, a million, maybe a couple of million until mainnet is released. And once Bitcoin and Ethereum is ready, that will move into the multi-chain testnet and then multi-chain chaosnet. So that chaosnet will feature real Bitcoin, real Ethereum, real Binance Chain assets, and mainnet. So that will happen toward the end of this year.
It's pretty cool.
Yeah,
So
I just
what kind
wanted
of
to
incentives do someone like me have to move my assets from being stranded and not generating anything to provide liquidity? Let's say Bitcoin. What am I making? 40% APY?
So the reason that where that yield's coming from is right now you would say if you're lending your Bitcoin out on BlockFi, you'd be getting its token exchange rate because they're putting it out to lending markets. So some problems here. One is apart from if you don't like the KYC, and the fact that BlockFi regrettably was breached recently in terms of its data, though I don't think the effects of that breach were too severe. But I mean, you're trusting someone else with your data, your assets. You're trusting that they can redeem it and they're actually solvent. And probably most of the exchanges out there today are insolvent, which is why none of them do proof of reserves. So none of them can prove that they've got all the Bitcoin that they say that they do owed on their balance sheets. And there's been, Cryptopia, Quadriga, time and time again where exchanges have suddenly popped up to be insolvent. An exchange today is like a Thanksgiving turkey. For 1,000 days, its life is bliss, and then one day it wakes up as dead. Well, that's the centralized exchange that go insolvent. I hope you like that analogy.
I don't.
Now, it's true. Now, the difference with ThorChain is it has observable security, but more than that, it has observable solvency. So you can come, and I wanted to highlight the solvency. So right now, the testnet believes it has 408 BNB, 0.408 BNB. Well, let's actually verify that. So grab the pool address. So this one here, pull it up in the Explorer, and guess what? It has 408 BNB. So it is solvent down to the Satoshi, and you can verify that for yourself. Does the system have the BNB that it claims it has? It thinks it's got 408. Well, why don't I verify it? Actually, yes, it does. So one, it's solvent, but two, it will have observable security. So one of the things we spoke about is as long as the bonded capital is double the state capital, you know that no node is ever going to wake up and go, I'm going to steal some Bitcoin today. But it can't, because it's going to get slashed its entire bond. Well, why don't you just verify that for yourself? Jump on the network and actually see the active bonds, add them up yourself, and work out, is the system safe? If it's not safe, don't use it. If it is safe, then you're okay. But tell me this, how much Bitcoin does BlockFi have? And are they solvent? And two, what is their security model? And are you going to wake up tomorrow and find out the whole system is solvent? And what's preventing that? You don't have this kind of transparency with legacy systems that you do with ThorChain. So the most important there is you will realize you can put your Bitcoin into ThorChain system and it will be far more secure and reliable than any other system. But more importantly is its block rewards and that it's yield. Well, the yield, who's paying yield? Well, when you stake your assets into a system, people who demand liquidity at any given point in time will pay you those fees. And two, the system has an emission schedule over 10 years. Now, we've all seen the crazy rise of things like liquidity mining and compound liquidity mine, which probably sounds like you've interacted with. But in liquidity mining incentivizes participation, and as long as there is growth potential of the system, then it bootstraps its own adoption and liquidity very, very quickly. Well, that's the same concept with ThorChain. In fact, the team came up with the emission schedule over a year ago, and nothing's changed. So the plan is still the same. They need to launch a mainnet first. So this is certainly not a copycat, and probably, in fact, it's probably the inverse. Also, I want to say that Compound, the liquidity mining compound, what do you get? Well, you get a token that gives you governance rights, but also potentially a share of fees, although that's a little bit uncertain. Whereas the RUNE asset, when it's emitted into its own pools, what actually is it? Well, it's one-to-one bonded with its own assets. So it has instant purchasing power. That's determined. It's extremely liquid. It's backed by the assets in its own vaults. And two, it gives you a share of the revenue of the system and now and into the future. So that's where the yield's coming from. In terms of the quantity, it's looking like the actual reward yield from its emission is around 20 to 25% starting off. And then from our investigations, the yield from fees is going to be another 15 to 20% over that. So in the first year, the team are guiding for 30 to 40% yield on assets. Yeah, for those reasons. Many things can influence that though.
Yep. So, and you touched on this a little bit. Explain to me, why are people building decentralized exchanges? And I'm talking from an investment or some type of, how do the guys who are building this stuff make money? How do investors participate in this? Or is this just open sourced software that, is just to better humanity?
Like a public good. Yeah.
Yeah.
It's both.
It's a good point. I mean, so like, as an example, UniSwap's founder first built UniSwap, and the team are massive fans of UniSwap V1 and what the
fix the slippage.
Well, that's a function of the market. Yeah, but we hear you. Now, UniSwap was shipped under a public good, a 30 grand Ethereum Foundation grant, and Hayden team did a fantastic job shipping it. And then now they're following it up because there's investment potential. There's a growth pattern and traction. And there's investable metrics in this platform. So I guess that's with Uniswap. The same with Compound.
Explain to me though, if you want to use Uniswap as an example, what are the investable metrics and no one's going to buy Uniswap, so it's not going to have an exit. Am I going to get a share of transaction fees as an investor? How do I make an investment?
I'm not sure. All I know from Uniswap's perspective is that they have a function in their contract, fee to setter, at any time. The Uniswap team can activate that fee, and the fee that's collected, what is it, like 50 basis points in addition, that goes to the Uniswap team. Uniswap is a company. Uniswap is trademarked, so it has 3 trademarks, and when that fee
you can invest in Uniswap, the company, and there are indeed funds that have, but Uniswap, it will have a token soon. And the governance of Uniswap will go to a DAO. And this fee is not going to go to a company. It's going to go to the holders of the tokens. And I would be bullish on this asset. I think the design of Uniswap and its fee is probably gearing up to be a very mature and a good one. It's better than some other ones I've seen, because presumably, assuming that Uniswap can successfully skirt, probably the security laws, but the way you would do it is you would launch the token with no promise of fee revenue, wait till it's decentralized, and then your DAO would turn on that fee. So the DAO activates the dividend model of the asset and not a private company. So that's what's going to happen.
The challenge with that, from my perspective, is that at the moment there's a single team address, and there's no guarantee that those fees will be paid out. Like, there's no mechanism right now. There's just a single constructor, the fee to setter, and at any time.
They're not going to. No, I disagree. They're not going to do that. That would be damaging. They're not going to collect fee revenue as a company. There will be a token. The token will not have fee revenue when it launches. It will go to a DAO.
Yeah, you're probably right. It'd probably be like a career limiting move to do that. But I'd like to see a bit more. I'd like to see more information from the team, just to give some confidence to the community in terms of, the extent of decentralization. Yeah.
But these mechanisms have failed miserably, though, when we're looking for consensus and doing the right thing. And how are stakes on dividends actually distributed? Right. We've had a real tough time at this.
Mm-hmm. Yeah, an example has been Balancer. So Balancer's fee revenue model, I'm just trying to pull up the site, has been massively gamed. So to keep Balancer DeFi. Let's just quickly pull it up. what's the website? Here we go. The balancer fee model actually distributes assets based on balancer exchange. There you go. Based on CoinGecko's sensing of prices. So, I mean, this is extremely gained because Balancer allows you to stake any asset. So it doesn't care. It's not able to globally sense the purchasing power of any pool because any pool can have its own purchasing power. So they use a third-party API, CoinGecko, in order to determine that. And it's been massively gamed recently. So potentially Balancer's mechanism fee distribution is not the ideal one. Compound is a little bit more resilient to that because it's distributed autonomously and it's not manually distributed. You're right. All of this is a giant experiment. I don't think I've seen any really good liquidity mining programs. I've seen some good and some not so good ones. The challenge for the ThorChain team, and there's nothing changed about the design of how ThorChain distributes its revenue to users. In fact, we'll plot the bit of code that does it. But we've, the last 12 months, we haven't changed our position on this because we don't think it's vulnerable to the types of antics we've seen on other exchange platforms because it's able to sense the purchasing power in its own pools, thanks to having a common settlement asset. If you have a common settlement asset, you can sense the value anywhere in its system. So it can trustlessly, in a way that's manipulation resilient, sense price or sense purchasing power, and then distribute assets. And I'm just scrolling down to the bit of code that does this.
And the system income is distributed straight into the pools, and that generate fee revenue, and also to the node operators. So node operators accrue rewards that they then gain access to it when they churn out. But there is also the liquidity competition. So at the moment, you see a lot of sort of scam coins on UniSwap. Well, you can try to kind of list a scam coin on ThorChain, but only one pool is enabled every 3 days, and it's the pool with the most amount of liquidity as measured in RUNE. Okay, so if you don't have liquidity, unless you're prepared to put up a lot of liquidity, you're not going to get listed, right? So that's one of the kind of safeguards, and it's a little bit more complex than that. And there are like delisting functions as well, but that that ensures that it's only assets that are going to generate fee revenue for the system are listed.
Yeah, so I just want to pull up that bit of code. I like to back up everything I say here. So we can just walk through it. It's not hard code to read. So first of all, it says, do I have liquidity fees in this block? If there are liquidity fees, it means swaps were done. And all it does is it distributes the rewards based on, if there's no liquidity fees, if it's zero, so therefore it's zero, it will distribute the rewards based on RUNE depth. So the balance of RUNE, with the total amount staked, and then the total amount of pool rewards give out that block. If there are liquidity fees in that block, aka swaps were done, then it will go get all the liquidity fees, and then it will distribute the rewards, not based on pool depth, but based on the share of fees for that block. So this is extremely hard to game. If you wanted to try and game this, the first thing you need to do is stake a lot of RUNE, and then you get a lot of the pool rewards. But the second that someone does a swap in a pool that's not your pool that you're staking, well, they're going to get the fees. So not only do you need to stake a lot of RUNE, but then you have to generate volume and ensure that there's fees generated, not volume, but fees generated in your pool that you're staking in, which means the system is collecting revenue and distributing it to all nodes and all stakers in a fair manner. So we think this is really resilient to gaming because one, you've got to have a lot of RUNE, and two, you've got to generate not volume, but fees for the system. So yeah, and this is in completely autonomous.
Yep. No, that makes a lot of sense. And the gamer would lose control of the asset as it's being distributed in fees.
Correct. Yeah. So by gaming it, they're actually benefiting everyone else who's not gaming it.
That's right.
Yeah. So they lose control.
They'd be paying a lot of people, and they'd lose control of actually what they're trying to acquire.
Correct. Now, while we're in the code, another thing that the team are adamant about and will argue quite this and try and get the point across, but it's swap queuing. So ThorChain is not only resistant to front running, but it also maximizes revenue for itself. Now, if you were to make an Ethereum transaction, like on UniSwap, in order to front run you, so you're doing your 100 grand transaction, well, I want to front run you. So I will make a transaction, even just $1,000, but I'm going to get it in ahead of yours because I've read the mempool. Let's say you use 20 GWay. So let's quickly pull up the gas price. So you go, okay, no one's going to front run me. I don't care. I'm just going to use fast 28 GWay. Well, I can use 100 GWay and I can get my trade ahead of yours by paying more in fees. So I'm front running you, but I am paying revenue to Ethereum miners and not to UniSwap. And I am extracting value out of your trade by front running you. So me as an aggressive, manipulative market taker is paying revenue to Ethereum miners and extracting value from you and also from liquidity providers on UniSwap. Now this is bad. Whereas ThorChain has a swap queue. You cannot front run when the swap is being finalized. So getting back to the technology overview, so I just want to pull it up. Let's say that this is your incoming transfer. You can't front run me in the block. You can just hope to get it observed in the same block as I'm going to get. But if I use a good enough gas price, then and you use 100 GWay, we're both going to be in the same block. So we're both going to get seen by ThorChain at the same time. That you won't be ahead or behind me, it doesn't matter. And inner will go into the system. Now, typically exchanges, the nodes will try and reorder transactions and front run. So now we have to be worried about nodes. Can they front run transactions? Okay, put one ahead of the other. Well, turns out they can't either because the transaction isn't finalized until 2/3 of them have seen it. So I can't reorder the transaction by observing it faster than another node. All I can do is withhold my observation, but that still isn't going to slow the system down or reorder it. So again, as a node, I can't front run your transaction. So really, it comes down to the swap queue. Everything ends up in this queue, and the system does two things. First of all, it tries to do a maximum of 100 swaps in a block. Any more, and it will delay. And that's to give it an artificial cap and force a fee market. Secondly, it will try to do a minimum of 10 swaps in a block. So it means that it will always clear out the queue until the queue is empty. Then it scores them. And by the way, this code runs in milliseconds. It's not complex code at all. It simply grabs the value of the, first of all, it grabs the XY values in order to determine the fees. So it sorts by liquidity fee, i.e. what are the transactions that are going to generate the most revenue for the system? Then it sorts by slip fee, as in what are the transactions or the pools that are generating the most price discovery, as in a high slip transaction is more important than a low slip transaction because it's active price discovery.
Yep.
Adds the two together, so no one is particularly weighted over the other, and then orders, sorts by score. Boom. So the only way to front run me and my transaction, well, let's say you're doing a 100 grand transaction, like you were saying, the only way I can get in front of you, and let's say you used 28 GWay, well, I can use 100 GWay, but I'm not going to get in front of you then. The only way I can get in front of you is doing a 110 grand transaction in the same pool that you are. But if I do a 110 grand transaction, it means I'm going to get wrecked on slip on the way in. And all you need to do is add price protection into your trade, and then it will be refunded if you don't get the value you wanted. So it's really resistant. And by the way, because I front run you and I paid way more than I needed to, I'm going to get wrecked in fees. And arbitrage bots will reset the price and they will make money. So I've lost money, liquidity providers have gained, and arbitrage bots have gained. And you haven't lost anything. In fact, the only thing lost is 3 cents on the transaction because it was because of the gas price.
Interesting.
So that's how ThorChain is resistant. And it's called the swap queue, and nothing else makes sense at this point in time. Yeah.
No, it's very cool. It's very cool. Can you explain to me before we end this, like how do the economics work for RUNE? You know, so right now, the only way I really can invest in this project is by buying RUNE.
Yes. So this is important. A proof of work chain determines Sybil resistance by work, as in hash power. So if you control 50% of the hash of Bitcoin, then it means half the time you'll be able to add your blocks and get revenue and assert yourself onto the system. One CPU, one vote, as Satoshi said. In a proof of authority system, like say Cova and Testnet or some other proof of authority blockchains, like Hyperledger or whatever, you assert yourself with a KYC, with a passport and an entity and a corporate certificate and reputation. An example of a POA blockchain is Liquid sidechain, so blockchain Liquid. The exchanges run that system, and they don't want to, steal and reorder blocks because of they will damage the system and damage their own reputations. That's a proof of authority blockchain. Now, a proof of stake system allows you to control Sybil resistance because it assumes that capital has cost. As in, if you wanted to buy 10% of the circulating supply of RUNE and have 10% of the vote in ThorChain's block ordering and its system, then it's going to require you to expend capital. Now, this is where it starts getting very dicey, because if you support delegation, and as an example of a blockchain that probably isn't doing this the best, and I'm very vocal about this, and I've discussed this, is most Cosmos blockchains. We can see here, we can see branding, we can see signaling, we can even see how much they are self-delegating. So we know, as in, like, here's Binance staking. Guaranteed, Binance did not pay for any of this atom. In fact, here it is here. They haven't. This is all their user capital. And the farming yield of atoms and paying it to the users. But the problem is Binance did not pay for this 11 million atom. So we have eroded our chief security assumption that capital has a cost. Because now Binance didn't pay anything for this atom. So no, capital does not have a cost.
And this isn't critical of Binance, just FYI, it's just using it. JP is just using it as an example.
I understand.
This is for every exchange.
There's Bitmax. I mean, there are even funds up here, like Alpha Capital. So again, self-delegation. So these funds and capitals and exchanges did not pay for this atom. So they've got a share, they got equity in a network, and security network they didn't pay for.
Yes.
This is the reason why ThorChain has two important distinctions. One, it demands anonymity from its nodes. You can only identify a node temporarily by its IP address. No more. There's no names or that nonsense, because that creates social signaling, it creates delegation, and it erodes the assumption that capital has a cost. Because the chief assumption of ThorChain, as mentioned, is capital has a cost. If nodes didn't pay for this bond, then yes, they're going to go away and steal your assets because it's zero cost to them. So there's those two things. Capital has a cost and no signaling. And that's the principles of ThorChain. And that's why it's called proof of bond, because they're actually, there's no delegation, but they're bonding into the system. So getting into your question is how to invest in the network or participate and get equity. It's acquiring the RUNE asset, and it's a strictly scarce asset by being no more than 500 million units with a very transparent mechanism of distribution to people who are aligned with the system. Because as I mentioned, the RUNE asset is not a currency. It's not a security. It is security equity into the network. And all the system has to ensure is that the RUNE asset is distributed to people who are long-term aligned with its own system and will bring net aggregate value. That's all it has to do. So as long as RUNE gets in the hands of people through the actual cost of capital or cost of time, and then it will ensure that it will be safe for years because collusion will never occur. So yeah, RUNE is the be-all end-all for ThorChain.
And if you're not a big whale, if you can't afford $1 million worth of RUNE to run a node, or you're not technically minded, then you can do two things. You can either hodl RUNE, which is not ideal. It doesn't really add much value to the network, and you're potentially losing out on some significant yield, or you can become a liquidity provider. And as you know, RUNE is bonded at a 1-to-1 ratio with other assets and pools. So at some stage, you're going to be forced to decide, okay, well, what pool are you going to support? Are you going to add liquidity to the Bitcoin pool or the USDT pool or whatever? So those are your options. But ThorChain forces people to think about their capital efficiency because of that incentive pendulum that JP was discussing before. As the ratio between bonded and staked RUNE changes, then the rewards change. And so investors, the likely scenario will be people with large amounts of RUNE. They'll be heavily long-term aligned with the system, and they'll be doing three things. They'll be operating nodes. or running nodes to secure the network. They'll be staking liquidity, especially as the incentives for stakers increase. But they'll also be running arbitrage bots because they'll have direct access to, they'll be running nodes, they'll have access to the mempool, have direct access to the connected chain nodes. And so they will be very profitable arbitrages on the network. And what that does is it ensures that swappers are accessing liquidity at fair market prices and with low fees, because arbitrages will always arbitrage out the price imbalance to ensure that the prices of those pools are correct. So that's that trilinear relationship between the swappers, the stakers, and the arbitrages with nodes securing the network.
Very good. And let me let you finish. I don't know if we got through the whole presentation. I'm sorry about jumping all over the place.
No, we prefer it like that.
We enjoyed it.
Okay. You know, in conclusion, when are you guys launching? When are you moving from testnet to your full launch?
Yeah, well, as I sort of touched on before, we're in the kind of community testnet at the moment. We just, spun up testnet v4 yesterday. And so we're reaching out and working with some of the early node operators to kind of get them familiar with running a node. And they're kind of helping us to iterate on our documentation and our Kubernetes, setup. So we're looking at least a few weeks for testnet v4 before we move into chaosnet, which is single chain. So Binance Chain chaosnet. So that'll be Binance Chain, mainnet, real assets, real swaps. In parallel, we're working on finalizing a few things with multi-chain, so integrating Bitcoin, Ethereum, and stress testing the network. We've got one more security audit planned with Trail of Bits. We haven't kicked that off yet. So all in all, we're hoping we will definitely have multi-chain chaosnet this year. And mainnet is really just a label. Mainnet is really where the point at which we take off that chaosnet label. We destroy MEMA, which is, you don't think of it like an admin key because we can't really do anything with assets, but MEMA allows the team to control the cap on the funds of the network for security reasons. And the team can also, with MEMA, trigger a Ragnarok, which is essentially shuts down the network and refunds everybody. So in the event that a vulnerability was found, or like a critical vulnerability, the team could shut down the network, but it doesn't allow the team to steal or take any funds. So the distinction between chaosnet and mainnet is really destroying that MEMA. And JP, if you want to talk through what you're looking at now.
Yeah, so but the team are looking at, and probably initial cap around 100 grand for chaosnet. And here's some maths here. Rune's nodes we're bonding around 15,000 Rune, not 1 million. So the total bonded for 30 nodes is going to be about 450,000 Rune. The reserve's going to have 150,000 Rune in it. And then the total state cap will be about 100 to limit liability. And the MEMA will have the ability to change the emission curve to drive up and get the ROI required. But then, and all it will be doing is, once it's been running at this cap and the system is safe and there's been no crazy events, and the team probably need to look at why this reason is occurring a bit at the moment. So there's still some debugging going on, but then it will be as Kai said, destroyed, and the system will it will be slowly increase from 100, 200, a million, 10 million, until a point in time when the community, mostly the community, is happy that the system is safe. Then MEMA will be destroyed and it takes away that ability, and then the system is in mainnet, and good luck. The community now running the system, and that's it.
Yeah. So what does it look like? ThorChain at the end of this year, being able to swap real Bitcoin for real Ethereum or ERC20 or BEP2 assets in a completely permissionless and trusted setting with community run nodes. Whether MEMA is destroyed at that point and we move to mainnet, it really just depends, as JP said, on the confidence of the community. But it really doesn't have any material impact at all, because the team can't do anything. It can't sort of take funds or redirect funds. So pretty exciting times. I mean, this is a paradigm shift in liquidity, whichever way you look at it. And the team is really, what we've got now is a culmination of, about 12, 18 months worth of engineering and 2 years plus of research. It's all coming together right now. The team is extremely excited about it. We've got a heavily engaged community, and the team are also seeing incredible interest from funds who want to take up position in RUNE and also want to run nodes to contribute to running the network. As you mentioned before, Jason, it is also a public good. So it's something that the team have always felt passionate about and wanted to kind of give back to build something on this scale and with this much utility. I mean, this is really the holy grail. So it's very exciting times. The team can't wait to unveil a multi-chain chaos net later this year.
Yeah, look, you guys have done a lot of great work. This is super interesting, and I'll tell you, I appreciate the time that you spent talking about this today. What else can I do? In terms of participation.
Spread the good word.
Spread the word.
The key thing is the key thing that's for adoption is user education, as in like learning the system why it's better than other incumbents. Incentives, the ThorChain system will take care of the incentives. It will pay handsomely for everyone to participate. It just needs to know that people need to know that there's an opportunity, that they don't need to keep 10 Bitcoin on a Kraken account. They can move it to Asgardex, where they can see the solvency, they can see the yield, they can see the security of the system in a transparent way, and they don't need to wait a day to get the funds out. They can get it out immediately. User education, user awareness. The team are definitely not about aggressive marketing first, tech later. They're being very tech first, and then building the community along the way. People ask, but ThorChain don't pay influencers or any of that stuff. Everyone's incentivized. In fact, the part of the reason why Kai leads a team that's quite pseudonymous and it's quite hard to track down who's participating is because it's not about the team. It's not about Kai or myself as a researcher or Lena or Chad or whatever. It's about the project, and it's about its values and principles and its incentives, most importantly. And so you'll notice across Twitter and Telegram and Discord, the team are constantly pushing things back on the community. This is your product. What do you want to see built? The team will fund. The team will promote your memes. The team will promote your content. It's all about the community.
To some extent, it's like, it's a little bit cliche, but, don't ask what ThorChain can do for you. Ask what you can do for ThorChain. I mean, it's really cliche, but it's like, there's nothing stopping anyone from participating. Like ThorChain is the community, we've seen, some engineers who have demonstrated, some great products, some good thinking, and they've become part of the team. If you want to ship some code and submit a pull request to GitHub or GitLab, and you're doing good work, well, the team will go, well, hey, here's someone who can add a lot of value. Like, you're working for us now. I mean, that's happened. We've got 3-4 different entities, some individuals, some companies or whatever who are actively building on ThorChain right now, because decentralization is not a switch. It is not a one-time event. And this was discussed in the Decrypt article with the Aave CEO, and the reason why, the SEC and some people have come after some of these projects because they haven't been sufficiently decentralized. Decentralization is a spectrum. It's a continuum, and you have to start now. You have to start at the very beginning. And as JP mentioned, quite a good point, which is the social signaling of figureheads and CEOs and founders and co-founders actually inhibits it. It makes it very difficult to decentralize. I mean, I'm not a likable guy, so me sitting on Twitter trying to social signal or whatever, it's not going to work. So that's why the team have practiced that kind of pseudo anonymity from day one. And the other sort of philosophy or ethos that the team have adopted is this radical transparency, Jason. So from the very beginning, the code's always been open source, haven't been out in a cave hunkering down, building a product to be unveiled, gold-plated product at some point in the future, and then try to flip the switch to decentralization. No, the team's been building out and open from day one. And, we've had some people sort of, mention a few things on Twitter and be a little bit critical, and it's like, well, this is an evolving, emerging product. We're not going to gold plate. We're not keeping it a secret until mainnet. All the treasury reports are public. Dev updates are coming up to 1 year, 52 weeks of dev updates. So that radical transparency is very important to the team and the project. Yeah.
Very good.
Yeah, as Kai was saying, like you can foster this kind of community spirit, community first spirit by just being incredibly transparent. So like everything from the treasury report, the distribution of the asset, the dev updates are public, because there shouldn't be any asymmetric information as to where the project is. It's a public project with public money that needs to be shipped. And so it shouldn't be at any surprise of what the treasury value is and what it's been expended on.
Yeah, and who's investing
no one should
in
be
the
surprised at that.
Every single investment
exactly.
has been disclosed. I mean, this opacity is a risk. Like, there's a reason why opacity exists. Like, why are you being opaque? Sometimes there's a reason, like if you're doing an exchange listing or something's very confidential. But opacity is a huge problem, and it's a big failure mode. And it means that you are actively holding on to and keeping risks from being communicated to the public. Being transparent means you're doing your very best, hand on heart, to communicate everything about the project, including some of the risks of the project. And for that, if you have a fiduciary responsibility, if you do think as a crypto project you do have some fiduciary responsibility, then that's what you will do. You will be transparent.
That's very cool. Very cool.
Awesome. Well, it's been great to chat, Jason. Hope we've answered all your questions. And hopefully you can see the vision of ThorChain and where it could be. You know, in 5 years' time, if you could ask me where I would like to see ThorChain as part of the part-time research of the team, that I help the team with some of the analytics and blah, blah, blah. I would like to see ThorChain as one of the leading exchanges with, and these are my personal thoughts, but let's go for $1 billion locked in its vaults, 99 nodes that are run anonymously, no major issues. The chain has been upgraded safely over time. The targets being hit, and that could be achieved within 5 years. And those are my personal thoughts. That's the vision of ThorChain. And you don't need to lock up your Bitcoin on BlockFi or a centralized lending platform. Why don't you put it on a platform that's transparent, that's auditable, and you can view everything about the system. That's the vision of ThorChain.
Yep. No, I totally get it. I totally get it. And I'm certain I'm going to have more questions and follow up, but man, I appreciate the time, and I look forward to talking again to you guys soon.
For sure. Thanks for your time, Jason.
No problem. Thanks, Jason.
Yeah. Take care.
Bye.
Cheers. Bye.